Hello, everyone, and thanks for joining us for another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner. I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. So we've got a smattering of everything on today's show. First up, we're going to be talking about mutual funds and the question of whether you're getting what you're paying for if you're buying actively managed mutual funds. We've talked about active versus passive management styles on the show before, and if you've elected to go active, are you getting what you're paying for? So we're going to talk about that. We're joined by our guest, financial planning pro, Matt Sweet, certified financial planner with Randall Financial Group, and my partner. And I'm happy to have him here with us. We're going to be talking about interest rates in a Trump presidency. We've already seen some activity not only on the stock market, which you may be aware of, but also in the bond markets with interest rates. So we're going to want to talk about that. So we have that coming up. We're going to be talking about credit scores. Have you ever wondered how your credit score stacks up to those people around you, whether it be in your state or nationally? So I have some figures to share with you so you can get an idea of how you are relative to everybody else, because I think we always like to find that information out. So we're going to have that. And then finally, at the end of the show, I'm going to share with you some of the thoughts I have on market activity, stock market activity right around the election, because I think it's interesting, relevant, and relative to some things we've talked about over the past month. So we've got all that coming. All right, so up first, are you getting what you're paying for if you're buying an actively managed mutual fund? Now, like I said, we've talked about on this show before the difference between active managers that manage a fund and make conscientious decisions about what stocks and or bonds that they're going to buy. Are they going to buy Coke? Are they going to buy Pepsi? Are they going to buy Google, or are they going to buy Yahoo? Making decisions about what stocks go in that portfolio in an attempt to outperform the market. And that's a style that contrasts with the passive investment style, which is the idea that you're going to buy a passive investment that really just tries to mimic the market. And I've advocated on this show in the past for a passive style, and there are a variety of reasons for that. But you may have elected to go a different direction and chosen actively managed mutual funds. At one time, that was definitely the dominant style of mutual fund, and things have started to evolve significantly. We've talked about some of the advantages of passive versus active. Passive having lower fees and the potential for better performance, certainly not seeing underperformance. But if you decided to go with active funds, the question is, I want to ask, are you getting what you're paying for? It's important to understand that because active managed funds are more expensive than passively managed funds. So if you're paying for active management, you want to be sure that the manager is in fact actively managing the fund, because there's a possibility that that active fund that you're paying extra for is really doing nothing more than mimicking a passive fund. We call those closet index funds. And the idea is the manager essentially mimics the index in the hope that they're never going to lose really badly to it, because they know that that's bad for business. But in contrast, they're never going to do a lot better, and they're actually charging for the privilege. So that's something that investors should know. The problem is it's very hard to determine that. Recently, some researchers associated with a couple of different university institutions have developed some methodology for looking inside of a mutual fund to determine whether or not the fund is actually actively managed, or if it's passively managed. They look at the holdings, they compare the holdings to their relative index, and they make a decision about how much the holdings in particular differ from the index. So if the index has 3% Apple in it and the fund has 3% Apple in it, that 3% of the fund is not actively managed. So what they came up with is the idea that if 80% of the assets or more of a fund differ from the index, it's considered pretty heavily actively managed. If 60% or less of the assets in the fund are actively managed, it's really considered a passively managed fund that you may be paying top dollar for the privilege to simply own an index fund. So it's kind of an interesting scenario, and they actually have a website you can go to, and I'll share it with you now. It's called activeshare.info. So if you go to www.activeshare.info, you can put in the ticker of your mutual fund, and you can get an idea of how actively managed it is. Again, 80% or higher, pretty active. Less than 60%, pretty passive, and you want to make sure you're getting what you're looking for. Finally, let me throw up this slide and talk about the trend of active managed funds. And basically what we're looking at here is since 1980, the percentage of assets in mutual funds actively managed versus passively managed. And you can see that trend line going down pretty substantially, hitting a low point around 2000 and then being mostly flat. That is the decline in actively managed funds. So this is not a conversation or a graph representing just the difference between, say, index funds and actively managed funds. This is the idea that even actively managed funds are becoming fewer and fewer, that although the fund may describe itself as actively managed, in fact, more and more funds are acting like passively managed funds. And I can't reinforce this point enough, that if you've made a decision that you're going to own a mutual fund, and your expectation is that that mutual fund is going to compete against an index, and that the manager is going to do better because of their prowess at picking stocks or bonds, and that you are paying for that, then you need to make sure that that manager is actually doing what they're charging for. And in many cases, those managers are not. They're merely mimicking an index fund, and you could have purchased that same index fund and you could have done so a lot cheaper. So you really need to ask yourself, are you getting what you're paying for? And if you've decided to go active, just make sure you're in fact getting a manager that's making active decisions about the management of the portfolio. All right, up next, I'm going to be joined by our financial planning money pro, Matt Sweet with the Randall Financial Group. We're going to be talking about interest rates in a Trump presidency. So stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined by my partner in crime. Hopefully no crimes. We should correct that immediately in case there's any regulators watching. But of course, my partner in Randall Financial Group, Matt Sweet, and our financial planning pro. And we're going to be talking interest rates today. We could have a whole show on just what's happened so far. As we tape this, we're about a week out from Election Day. Right. We could have an entire show on what has happened in the markets, maybe a week prior to the election to right now, and we're not going to do that, but we are going to talk about interest rates. Because I think it's an important topic, and you brought it up to me. You said, hey, I think we should talk about this because it's fairly obvious that the new president and his economic plans are going to have a pretty distinct impact on our economy. And interest rates are a big part of that. But before we leap into that conversation, we've been talking about interest rates for a long time. I mean, it's not a new thing. Let's remind the viewers about a couple of things relative to interest rates. And one of them is the Federal Reserve, which is, of course, a quasi-autonomous, supposed to be completely autonomous government body, separate from the executive branch, that's really our nation's bank. And a lot of people are under the impression that they set interest rates for the country. Not quite the truth. What's the reality about what the Federal Reserve's responsibility is?
Well, the Federal Reserve sets an interest rate policy for the Reserve itself, which generally only governs short-term interest rates. And it has mostly to do with the interest rates charged between large national banks. So that's where their direct
discount rate,
federal funds rate. So that's like the direct action of the Fed. But they have also have an effect on longer-term rates and other rates throughout the economy just by virtue of what they're doing with short-term rates.
And we've seen, I looked up some data in advance of the show. The past 10 years, interest rates have been at historic lows. But certainly since the financial crisis, we've seen rates quite low. They managed to rise somewhat around 2013, but since mid-2013, rates have generally, when you look at intermediate to long-term rates, short-term rates, whatever you want to look at, have generally declined in the past 2.5 years. Why has the Fed struggled so badly to raise interest rates? I mean, if you're a borrower, low interest rates are a good thing, but why is the Fed trying to get them up?
Well, they have to struggle with a couple of different things. One is the Fed is concerned with full employment and inflation. Those are the two things that they are concerned with whenever they're thinking about rates. So on the one hand, they're trying to increase economic growth as much as they can to encourage full employment. And on the other hand, they're trying to avoid inflation. So it's, I think, a matter of the Fed not wanting to stall the economic growth, because it's been not very high. We've had basically 2% economic growth over the last few years, which is historically fairly low. So I think the Fed wants to avoid putting downward pressure on the economy by raising rates too fast.
And of course, we've seen them, they've raised the discount rate once in the past year. At the beginning of the year, they indicated they wanted to do it a couple of, or if not 3 or 4 times this year. They haven't been able to do that. There have been a couple of different episodes with stock market shocks where they've been reluctant to, after the market dropped, to also pile on with an interest rate increase. But clearly their intent has been to try to move interest rates up. Their target short-term rate is a fair bit higher than where it is right now. Is that fair to say?
That's right. That's right.
So it's important for viewers to understand, though, that it's not just the Federal Reserve, and in fact, the Federal Reserve may play the minority role in setting interest rates. It's really the open market that sets the majority interest rates. So let's talk about what role the market plays in interest rates, what the primary rates are that we pay attention to, and how the market impacts those rates up or down.
Yeah, I would say the most important rate that we look at to try to gauge the markets is the 10-year Treasury, to see, is it going up or down. It's affected by virtually anything that happens in the economy, particularly the sentiment of where people think the market's going, and also what they think the Fed is going to do with interest rates. But it's really affected by the whole global economy, including exchange rates and things going on anywhere else in the world.
But I think some of and I couldn't agree with you more. Interestingly, I think some of the confusion that people have when we talk about the 10-year Treasury is, I think most people are broadly aware that the 10-year Treasury is a government bond. It represents the government borrowing money. But it's not about the rate that they've set on the 10-year Treasury. That's a bond that has a 10-year maturity, and we could be talking about bonds that were issued last year, 2 years ago, 5 years ago. That's not what drives the interest rate on the bond. What we're talking about is the yield, which is driven by the price of the bond, right?
Right, exactly.
So what impacts the price of the bonds? I mean, why would money flow into bonds or flow out of bonds?
Right. Well, exactly. The price of bond is driven up by, if there are a lot of buyers in the market buying U.S. Treasury bonds, the price is going to go up. So, where do those buyers come from? Sometimes they come from overseas. People looking for a safe place to put their money. That's one of the primary things. The treasuries are seen as the ultimate safe place to put money. And so when anything goes bad anywhere, people flock into treasuries, and that boosts the price.
That boosts the price and
lowers the yield.
And that's the key. So people look at it as, do I have a better option for my money? I know the 10-year Treasury is safe. I know it's guaranteed. I know the U.S. has never defaulted on debt. So if I put my money there, I know it's a safe thing. So in times of stress, or when other options aren't that attractive, money flows into treasuries, drives the price of the bonds up, and drives the yields down. And that's a lot of what we've seen at different points in time where the market has peaked. So that, I think, that's a relationship that people really need to appreciate. Of course, if the market looks like it's doing well, people say, well, why do I want a fixed rate of return when I can make more money in the market?
Yep.
They pull their money out of bonds, bond prices drop.
Stock prices may go up, just like they have post the election.
And yields go up, right?
Exactly.
So that's that's exactly what we're talking about. So let's get into the heart of the matter with the Trump election. Now, I think it's safe to say that regardless of your political affiliations at home, that the Trump election was a surprise. My sense in watching him on TV, it was a surprise to him. So I don't think I'm giving anything away when I say it's a surprise to most of us. Least of all was it a surprise, or most of all, it was a surprise to the stock and bond market.
Right.
So I think we have to think about that. But here's what we've seen, and let's talk about this. Since Trump has been elected president, and bear in mind, this show is being taped only a week after Election Day. You're going to see it a couple of weeks later, but just a week after Election Day, we've seen the 10-year Treasury yield rise about 35 basis points, or 0.35%. Now again, what causes that? Bond prices have gone down, yield has gone up. That means people are pulling money out of bonds and they're investing elsewhere, right? So that's definitely a trend we've seen. 30-year mortgage, which perhaps is something people can relate to a little more as consumers, we've already seen the 30-year mortgage average rate jump 40 basis points since going back to mid-October. So that's not entirely an increase since the election, but not too far before it. So those are some of the interest rate moves we've seen. And of course, a 30-year mortgage driven off of Treasury bonds. So those two things are highly interrelated. But what do you think is going to be the impact with respect to interest rates of a Trump presidency? Or what are some of the potentials? I won't ask you to predict because that's not the business we're in. But what are some of the potential impacts of a Trump presidency based on what little we know of his economic policy as far as how they could impact interest rates?
Okay, well, one thing I want to say is the Fed tries to be as independent as possible when they're setting interest rate policy. So that's not always possible. But the things that they'd be looking at is what trajectory the economy is expected to take. So if Trump is a pro-growth president and is actually is expected, or we actually start seeing real growth in the economy, growth in jobs, we would expect the Fed to increase interest rates.
To almost cool things off is one of their sort of roles. And I think most of what we've learned about Trump's economic plans, what little there is that he's definitely going to be a pro-growth. Now, you might not think it's the right kind of growth, but he's talking a lot about infrastructure, a lot about spending. That's a growth bias. Would you agree?
Oh, yeah. I mean, he's talking about corporate tax reform, which is positively seen by the stock market, and deregulation, things like that. Those are all things that should increase economic growth.
So 15 seconds left. In the short term, we've seen interest rates rise. Fairly good likelihood it's going to keep going?
Well, the expectation is the Fed is going to raise interest rates in December, regardless of who the president was going to be. So we'll see if they actually do that. And then
we'll have to follow the 10-year Treasury.
Right.
All right. Well, we've been predicting rising interest rates for a long time, so
right.
I always insert this caveat. It could be upon us, folks, but then again, it might not be. So, all right, Matt, thanks for joining us. Great conversation as always. All right, up next, we're going to be talking about credit scores. How does yours compare to everyone else's? Stay with us. We'll have some numbers for you. Be right back. Welcome back to the Money Pros. We've talked about credit scores on this show quite a bit and the importance of them. We're going to talk a little bit about how to compare your credit score to everyone else's. So I came across some interesting numbers, and as always, I want to try to share them with the Money Pros viewers. But let's really quick review the importance of credit scores. They have a huge impact on your economic life. In fact, I was quite pleased when my about to head off to college daughter said she thought she should get a credit card. And when I asked her why, expecting it was so she could pad her wardrobe, she said, because I want to build a good credit score. So kudos to her. Whether she actually meant that or not, I'm not sure. But they have a huge impact on your financial life. It can affect your ability to borrow, obviously your ability to get a credit card, to get a mortgage, to get a whole slew of different types of loans that you may need, car loans. It can affect the cost. A lot of these loans you're going to need. Most of us need a car loan. We're going to want a mortgage at some point. And the higher our credit score is, the cheaper those loans are going to be. So that score alone can have a massive impact on your wallet from that standpoint. It can impact your ability to rent an apartment or to get a piece of space for business if you're going to rent an office or something like that. And it can also impact hiring decisions, because more and more employers will look at your credit score and they'll use that as a metric as to whether you're a responsible individual or not, particularly if you're involved in handling money or things like that. So having a good credit score is really critical. So I want to reinforce that. Now, the credit score is just one way that lenders look at your credit, and the various credit reporting agencies generate this number that indicates whether or not they think you're a good credit risk or not. So, the most common scoring system is known as FICO, but there are other scoring systems that work very similarly. And what I think is interesting is we talk about what sort of good credit is versus what bad credit is, but how many people have good credit versus how many people have really lousy credit, not only nationally, but more close to home, those people that live, say, in Rhode Island and Massachusetts, the people that are watching this show. So went to one of my favorite websites for kind of off-the-wall financial statistics. It's called Wallet Hub, and checked them out. and they have some interesting statistics on the breakdown of credit scores nationally. So let me put up this slide and we'll talk about this. Now, these are national figures for credit scores, and of course, to evaluate your own, you'll have to know what your credit score is. But for people with credit scores between 300 and 599, and I think most lenders would say that this is either bad credit or weak credit score, as a percentage of the U.S. population in 2015, that was 21, nearly 22%. Now, if we move up the spectrum, scores from 600 to 699, that's about 23% of the U.S. population, and that would be considered a mid-tier credit score. You'll get credit maybe slightly more expensive than if you had top-tier credit. And then top-tier credit, most people would consider 700 to a max out at 850, and that, in fact, is 55% of the population has credit above 700. So that's a pretty significant number, but it's also a significant minority that has less than perfect credit, and that represents a lot of expense. So some of the interesting numbers I wanted to pass along to you on a more localized basis. What's the state with the best average credit score? Have any guess? Well, it turns out it's our friends in Minnesota. The frozen north of Minnesota has the highest average credit score of any state with a 704 average credit. What's the lowest? Unfortunately, our folks, neighbors in Mississippi, have the lowest credit score. Average credit score for that state is, in fact, a 637. So that means the average borrower in Mississippi is paying more for their loans simply due to lesser credit. Finally, Massachusetts comes in at number 10 with a credit score of 688 on average. And here in Rhode Island, finally one of the things where we're not near the bottom of the list, we actually come in at 15, number 15 with an average credit score of 682. So get your credit score. We've talked about how to get that in the past. Compare it to everybody else and work to improve it because it can only improve your financial life. All right, up next we're going to be talking about some thoughts with regard to the stock market around the election. Stay with us. We'll be right back. Welcome back to the Money Pros. In our close, I don't have quite as much time as I was expecting earlier in the show, but I do want to point out for viewers that it's important to take a look at what happened to the stock market in the midst of the presidential election returns and slightly thereafter. Immediately during the returns, we thought it was going to be a bad close the next morning. It turns out the stock market has spiked, a good reason why you shouldn't ever try to time the markets based on your expectations. Hey, thanks for watching the Money Pros. Be sure to watch this again next week, same time, right here on the Money Pros. Take care, folks. Have a great weekend.